Hey everyone, welcome back to Corporate Decoder. Today, S.E.E.R Incorporated just filed an 8K reporting on their annual stockholder meeting, and I am seeing a surprising outcome that everyone should know about. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company held a big meeting where shareholders voted on important things. And one of those votes did not go the way the company likely hoped. So this is a current report filed by S.E.E.R Incorporated on July 28, 2026. It covers events that happened during their annual meeting of stockholders on July 28, 26. The company needed a certain number of shares to be present for the meeting to officially happen. They had over 55 million shares of Class A common stock available to vote on May 29, 26, which was the record date. And a good chunk of those shares, over 43 million, were represented at the meeting, which means they had enough to have a quorum. A quorum is like a minimum number of people needed to make decisions in a meeting. Now let's get to what they voted on. The first big item was electing 7 members to the board of directors. These directors are basically the top decision makers for the company. The idea is they would serve until the next annual meeting in 2027. The company announced that 7 directors were elected, and they listed out the votes for each of the company's nominees, and also for nominees put forward by something called the Radoff-JEC group. Looking at the votes for the company's own picks, Omid Farokhzad MD received about 24.6 million votes for and 18.8 million withheld. Meeta Gulyani got a much stronger 34.1 million votes for and only 9.4 million withheld. Robert Langer CD also did well with over 33.7 million for. Isaac Rowe also had a strong showing with over 34.1 million votes for. Nicholas Roloff's PhD received about 30.7 million votes for. However, Terrance McGuire only got 19.1 million votes for and a whopping 24.4 million votes withheld. This suggests a lack of support for him. Now, when we look at the nominees from the Radoff-JEC group, things are pretty stark. Howard H. Berman PhD received only 16.6 million votes for and a massive 26.9 million withheld. Joshua Horowitz got just 10.7 million votes for and a huge 32.7 million withheld. Luisi Reinaldini received 15.9 million votes for and 27.5 million withheld. The numbers show that the company's nominees generally did much better than the Radoff-JEC group's nominees. It seems the shareholders preferred the company's existing leadership slate over the alternatives proposed by Radoff-JEC. Next up was a vote to approve Deloitte and Touch LLP as the company's independent auditors for the fiscal year ending December 31st, 2026. This is a pretty standard vote that happens every year. Auditors are super important because they check the company's financial records to make sure they are accurate. The results here were overwhelmingly positive. Over 31.4 million votes were cast in favor of keeping Deloitte and Touch. Only a little over 500,000 voted against it. There were about 11.6 million abstentions, which means people who did not vote either way. This shows a strong endorsement for the company's choice of auditor. Then there was a vote on the compensation of the company's top executives. This is often called a say-on-pay vote, and it is usually advisory, meaning the board is not legally required to follow it, but it is a strong signal of shareholder sentiment. Here we see about 25 million votes for approving the executive compensation. There were over 9.5 million votes against and almost 9 million abstentions. This is a mixed result. While a majority voted for it, a significant number of shareholders expressed concerns or disapproval by voting against it or abstaining. This could signal shareholder unhappiness with how much the top brass is being paid. Now this is where things get really interesting. The last item was a vote to ratify the Tax Benefit Preservation Plan. This plan sounds like it is designed to protect the company's ability to use tax benefits, and the shareholders did not ratify it. This is a pretty big deal. Only about 19.8 million votes were cast in favor of ratifying the plan. However, a substantial 14.5 million votes were cast against it, and another 9.1 million abstained. This clearly indicates a lack of shareholder support for this particular plan. It is worth noting that this vote happened on July 28, 2026, and there have been recent news headlines around that same time about revised unsolicited acquisition proposals for S.E.E.R, incorporated from the Radoff-JEC group, and even from the CEO himself, Omid Farokhzad, MD. This failed vote on the Tax Benefit Preservation Plan could potentially be related to these ongoing acquisition discussions. Sometimes companies put these plans in place to make themselves less attractive to potential buyers or to give the board more leverage. The fact that shareholders rejected it suggests they might prefer the company to be open to acquisition, or perhaps they just did not see the value in the plan itself. Looking at the broader context, S.E.E.R Incorporated, a player in the healthcare and biotechnology sector, has a market cap of around $122 million with a stock price trading near $2.20. Recent news on July 30th, 26. just a couple of days after this meeting, indicated that S.E.E.R confirmed receiving further revised unsolicited acquisition proposals. This includes revised proposals from the Radoff-JEC group and from CEO Omid Farokhzad MD himself. This acquisition activity, coupled with the shareholders' rejection of the tax benefit preservation plan, paints a picture of a company potentially undergoing significant change or strategic evaluation. The vote against the preservation plan could be a sign that shareholders are signaling a desire for a different path forward, perhaps one that involves a sale or a change in control. The fact that the CEO is also making a proposal to acquire the company adds another layer of complexity and intrigue to the situation. It suggests internal dynamics might be at play alongside external interest. The rejection of the tax benefit preservation plan is the most critical takeaway here. It suggests that shareholders are not aligned with the board's strategy on this front and may be signaling a preference for a different outcome. Possibly an acquisition. This aligns with the recent flurry of acquisition rumors and proposals. The mixed results on executive compensation also warrant attention, indicating some shareholder dissatisfaction. The strong support for director nominees and auditors, however, provides a baseline of confidence in the current leadership and financial oversight. My biggest concern is the potential for continued uncertainty and internal conflict, given the CEO's own acquisition proposal and the failed shareholder vote on a key corporate defense mechanism. What I'm actually looking for is clarity on the acquisition front and how the board will respond to the shareholder vote on the preservation plan. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please like this video and subscribe for more. Also, join our Discord community in the description.